Remember GameStop in January 2000? Toborne Ancharingwen 21. The stock soared from $17 to $347 in less than a month. Not because of fundamentals or earnings, but because millions of people saw others buying it. And jumped in too. By the time most retail investors heard about it, they were buying at the peak. Within weeks, many had lost their savings. This wasn't just about greed. It was about one of the most powerful forces in human psychology, social proof. Our deep-seated tendency to look to others to determine correct behavior. When we see masses of people doing something, our brains tell us it must be right. This instinct served our ancestors well. If everyone in your tribe suddenly started running, you'd better run too. The ones who stopped to independently verify the threat probably didn't survive to pass on their genes. But in modern financial markets, this same instinct can be devastating. Behavioral economist Robert Shiller documented how social proof creates price bubbles. Information spreads through social networks, creating feedback loops where rising prices attract more buyers, pushing prices even higher, until reality finally catches up. Professional investors aren't immune. A study of mutual fund managers found they were more likely to buy stocks that other managers were buying, even when those stocks subsequently underperformed. The pressure to follow the crowd is so strong, it can override years of training and experience. Think about crypto in 2021. Bitcoin hit $69,000 not because of any fundamental change in its utility, but because everyone was talking about it. The more people bought in, the more others felt they were missing out. By 2022, over $2 trillion in crypto market value had evaporated. The financial cost of following the crowd is staggering. Studies of investor behavior consistently show that buying what's popular, usually at peak prices, and then selling in panic when prices drop leads to returns far below market averages. One analysis found the average investor underperformed the S&P 500 by 4.5% annually over 20 years, largely due to crowd-following behavior. But here's the fascinating part. Knowing about social proof doesn't make you immune. Even behavioral economists who study these biases admit to feeling the pull. The key isn't to deny these impulses. It's to build systems that protect you from them. Or first, create an investment policy statement. Written rules about what you will and won't invest in, based on fundamental criteria, not popularity. When everyone's talking about the next hot stock or crypto, your policy statement becomes your anchor. Second, institute a mandatory waiting period for any investment not in your original plan. The brain processes social excitement in the same regions that process cocaine cravings. But unlike drug cravings, investment FOMO usually peaks and fades within 48-72 hours. Make yourself wait 3 days before acting on any new investment idea. Finally, track your social proof triggers. Write down every time you feel pulled to invest in something, because everyone's doing it. Review this log periodically. Patterns will emerge about when and where you're most vulnerable to crowd psychology. Remember, the crowd isn't always wrong. But by the time something is popular enough for everyone to be talking about it, the biggest gains have usually already happened. The real money is made by those who get there first, or those who stick to their strategy regardless of what others are doing. The research discussed here reflects findings from behavioral economics and psychology. While these insights can inform your thinking, they're not financial advice. Always consult a qualified financial professional for decisions about your specific situation. Your brain may be wired to follow the crowd, but with the right systems in place, you can choose a different path. Mind over money. Understanding why you make the decisions you do is the first step to making better ones. Follow the channel for more.